Okay, Professor, so let's move on with our discussion. So I don't know, you would want to take note of some of the things here, and let me try to get in some specific information for us. So we have been able to determine that under the sole proprietorship, you'd have a scenario where you have to calculate depreciation. Okay, and we are saying that the two main methods we are going to use are straight line method and the reducing balance method. For the straight line, now here you can even focus on how you get the depreciation. You apply the rate on the cost of the asset. But for the reducing balance method, you apply the rate on the book value, the net book value of the asset. So let's get those specific details down here. So for straight line, we're saying charge the depreciation on the cost. And then for the reducing balance, you charge on the net value. Now, from the balance sheet, you remember that this net book value, you determine it by deducting the depreciation from the cost of the asset. So accumulated depreciation. Accumulated depreciation simply means all the depreciation you have charged on the asset for the previous year. Okay. So let's do some example here. Imagine if we are given, let's say, furniture, which has a cost of say 150,000, and then we are told to charge depreciation on this asset at 10% straight line method. My dear professors, what they are trying to do, or what they are trying to tell you, is that if you are calculating for the provision for depreciation, you just multiply the 150,000 by the 10% given, and I think that will give you 15,000. That's all. Okay, but if it is the reducing balance method, then for that method, sometimes check the question, they would give you some previous depreciation. It's not always the case. There are some questions there will be no previous depreciation. In that case, your reducing balance method would have an answer which is the same as that of the reducing balance method. As a matter of fact, in the first year that you calculate depreciation on an asset, the value for the straight line and the reducing balance will be the same. But when you move to the second year, okay, that of the reducing balance will change, because then you would have to less the first year depreciation from the cost of the asset before you multiply. So let me again use this same scenario, okay, so that we can get a better picture of it. It is a topic that we have to do in details, right? Provision for depreciation is a topic, but we are now looking at it just under the sole proprietor. So I don't want to give you a lot of information to confuse you. So you let me stick to what we are doing. So just remember that the two methods that you'll be meeting here are the straight line and the reducing balance. For the straight line, you multiply on the cost of the asset. For reducing balance method, you multiply on the net book value, which is the cost minus previous accumulated depreciation. Please, any question on this? Okay, so if you are clear with how you calculate it, then you now think about how you treat it in the final account. So this is how you treat it in the final account after you have calculated it. So after calculating it, you take it to the profit and loss account as expense, and the name of it will be provision for depreciation, and then you add the assets to it, maybe provision for depreciation on fixtures, provision for depreciation on equipment, etc. Okay. Now in the balance sheet, you remember when you are presenting your fixed assets, you show the cost, depreciation, and net book value. Okay, so in the balance sheet, the accumulated depreciation, both previous and current year, is deducted from the cost of the asset. Okay, so I think it will make a lot of sense when we look at illustrations. And so let me design an illustration here. So we are still using the old illustration, or if not, no, let's use the old illustration and assume that provision for depreciation is 10% on cost of the asset. Okay. So when you see 10% on cost, then they are referring to the straight line method. So as you see this, the principle is that you first need to calculate the depreciation. So if it is 10% on cost, then we look for the assets. Here it says on the asset. So every fixed asset you see, you have to calculate that depreciation on. And lo and behold, we have only two assets, equipment and then building. Okay, so you multiply on the cost to get this depreciation. When you get it, you take it to the profit and loss account as expense. So under your operating expense, you would have calculated depreciation. So let me add on here. So you write provision for depreciation. Okay. Some people do the calculation on the face of the profit and loss account. Is expected or is normal. Others will go and do it somewhere as workings and bring the value. Okay, but let's do it on the face of the profit and loss account. So the first asset is building. So you multiply 10% by the cost of the building, which is 100,000. That will give you, say, 10,000. And then that of the office equipment, that is also 10%, multiply by 100,000. Sorry, equipment is 35,000. So we'll get 3,000. So this is what they mean when you calculate, take it to the profit and loss account as expense. When you get to the balance sheets, okay, this is where you now show the cost of the asset, accumulated depreciation, which you can shorten in this form, and then NBV, or the net book value. So here you show the cost of the building, which is 100,000, okay? And then the depreciation that you have calculated. Okay, so on the building, we have calculated 10,000, right? Sometimes check the trial balance. There will be some previous depreciation. If there is, you add the two. In this question, we don't have any previous in the trial balance. So it is just this 10,000 that will represent the accumulated depreciation. When you less it from it, you get 90,000, and that becomes the net book value. So for the office equipment, you show the cost 35,000, and then you less the depreciation, which is 3,500, to get the net book value. Okay, that is it. So my dear professors, you get this depreciation at least for the first step. If you have questions, please ask me. So going over this depreciation issue, the point I'm trying to make to you is that under the sole proprietorship or this final account trading profit and loss account, you'll be asked to provide for depreciation, what we call provision for depreciation. And I'm saying that here you consider two methods. There are plenty methods, several methods of calculating depreciation, but here we only consider the straight line method, and the reducing balance method. Now, for the straight line method, this is how you calculate the depreciation. You multiply the rate given on the cost of the asset. Okay. And the question will tell you that it's straight line or reducing balance. If it is reducing balance, then we are saying that you apply the rate on the net book value. So now let me cite an example. Let's assume that we have a building, okay, which has a cost or which was bought for 20,000, okay, and then it was bought on, let's say, 1st January 2006. Let's look at A, okay. Calculate depreciation using the straight line method at 10% per annum. Okay. So this asset was bought on 1st January 2006. Now depreciation is charged for 12 months or 1 year. So it means that in 2006 we have to calculate what depreciation for this asset. Look at how we are going to do it under the straight line method. We multiply the 10%, which is given as the rate, by the cost of the asset, 20,000, and that will give us 2,000. Okay. That'll give us 2,000. The second year, which is 2007, if we are still calculating depreciation using straight line method, it will still be the 10% times 20,000, and you get 2,000. The next year, 2008, it will still be 2,000. Okay, that is why we say under the straight line method, the depreciation is fixed. It doesn't change. It is fixed over the life of the asset. Okay, and you apply the rate on the cost of the asset. If it is reducing balance, things would have changed in that in the first year, 2006, okay, we'll calculate 10%, okay, times the net book value. But in the first year, okay, the asset was bought in 2006, so there's nothing like there's previous depreciation on the asset. So in the first year, under the reducing balance method, we're still going to have 10% times the 20,000, okay, which will give us 2,000. But in the second year, 2007, it is going to be 10% times the net book value. In this case, the cost minus previous depreciations you have charged. So you see that in 2007, we remember that, 2006, this asset was depreciated 2,000. So you less that depreciation from it. And that calculation is what we call the net book value. You less the previous depreciation from the cost. So you see that in the second year, we would have 10,000, 10% on 18,000. And our depreciation value will be 1,800. Now let's do for the last year, 2008. In 2008, it will still be 10% times again the net book value. How do you get the net book value? It is the cost of the asset minus all previous depreciations you have charged. So you realize that, okay, in the first year we charge 2,000, and in the second year we charge 1,800. So you less all those depreciation from it before you apply the rate. That is the principle of the reducing balance. That's why we say for that one, we apply the rate on the net book value. And net book value is the cost minus any previous depreciation. So you have to understand these two methods and how each of them operate. So for the straight line, you multiply on the cost. You don't go and check for any previous depreciation to less from the cost. But for the reducing balance, you use the rate, you apply it on the net book value. Where net book value is, pick the cost, check the question for the old or previous depreciation, less it from. Please, is it now okay with these two methods?
Yes.
Okay, that's fine. So if we have this idea, we are applying it in the question, the scenario. Okay. Now the issue is when you calculate it, you don't leave it like that. You have to present it in the final account. So the presentation is that you put it in the profit and loss account. So that's what it says. It says the charge. That's what you calculate. The charge for the current year determined is added to the expenses. So you add it to your operating expenses. Okay. And then in the balance sheet too, like I showed you, you less it from the cost of the asset. So let's apply this idea here. Now, let me do something here so that maybe it will make sense. Let me put previous depreciation in the question. Okay, so let's assume that there was previous provision for depreciation on just the building. And depreciation has a credit balance. So let me put 1,000. And then in the additional information, we are being told that provision for depreciation is 10% on what? Cost. So when you say 10% on cost, then they are referring to the straight line method. So under that circumstance, when you are preparing your profit and loss account, okay, you have to consider charging that depreciation. So you see under your expenses, you write provision for depreciation. The rule was 10% on the cost of the asset. Some of the questions, they will give you specific, maybe 10% on the cost of maybe the building, or the furniture is depreciated 5%, they'll tell you the specifics. But if it is general, then you apply to all the fixed assets you have in the question, the tangible ones. So this question was general. So we pick the building, right? 10%, we multiply by the cost. That's the straight line method. Whatever you get is what you put as the provision for depreciation expense. Office equipment to see, right? When we go to the balance sheet, when you present the cost of the building, professors, I'm telling you that first pick the figure you have calculated as depreciation here, which is 10,000, and check your trial balance if there is previous depreciation on that same asset. So in this question, we charge 10,000 in the profit and loss account. And in the trial balance, we have 1,000 here, giving us depreciation on the building. So you add the two together, making 11,000. And that's what you put there under your accumulated depreciation. Then you less it from the cost to get the net book value, which is 89,000 in this case. Now let's check for the office building. For the office building, 10% on cost. So we multiply 10% by the cost, which is 35,000. We get 3,500. In the balance sheet, we pick this figure and check the trial balance if we have any depreciation on the office equipment. Dear professors, we don't see any depreciation on equipment. We don't see any provision. The one given was on the building. So in that case, it means in the trial balance, there's nothing there. So you pick only this figure and take it there as the accumulated depreciation. I hope it makes a lot of sense now.
Yes.
Yes.
So that is the straight line method. If it is reducing balance method, let me convert it to reducing balance method. So it's still 10% reducing balance method. Then this is how the thing would have played out. In your profit and loss account, you still charge depreciation, so building, but this time it will be 10%, not on the cost. Okay, don't let your focus go on the cost because this is reducing balance. So your focus should be on the net book value. And what is net book value? The cost of the asset, okay, minus any previous depreciation on the asset. So the cost of this building is 100,000. We less any previous depreciation on it. And lo and behold, we have a previous depreciation of say 1,000 on it. So you less it before you multiply the 10%. So 100,000 minus 1,000, I think we'll get 99,000. You multiply by 10%, you get 9,900 as the depreciation. Let's do for office equipment. So for office equipment to 10% on the net book value, okay, where net book value is the cost minus any previous depreciation. Fortunately, for office equipment, there is no previous depreciation. So even if you less anything, it will be zero, right? So you don't need to even less it at all because there's nothing there is zero. So at that point, it will be the 10% times the 35,000. So that is the reducing balance. When you pick the cost, check if there is previous depreciation. Less it before you apply the rate. But for the straight line method, that one, it is straight away you apply on the cost. So I think it makes a lot of sense now. When you come to the balance sheet, it's the same. You pick the amount you got in your profit and loss account, and then you add on any amount in the trial balance assay. So for the case of the building, it would have been 9,900 plus the 1,000, giving us I think 10,900. And that of the office equipment will be 3,500 because in the trial balance there's no depreciation. So that's how you deal with depreciation. Please remember this, and you have a smooth journey when you are solving illustrations under trading profit and loss, and it is highly examinable. There is no WAEC or WASI question I've seen where there is no depreciation. I'm yet to see that. All the questions have this provision for depreciation, so please watch out. Now, another name for the reducing balance method is also called diminishing balance method. So when you see it, so any question, professors? Okay, so gradually we are moving on. Now we have exhausted 2 more of the adjustments, right? We have added on provision for depreciation and then drawings by the owner. So we have done 6, 4 more to go. Let's look for this 4 more to go, which is another a bit. I would wish to do this another time because if I add on to what we have done today, I may end up confusing my professors. Okay, I think we are left with only the provision for bad debt and then this interest on loan, right? The provision for bad debt also behaves like the provision for depreciation, but that one you have to check for. In fact, I don't want to do that today. So let me skip to the interest on loan. Okay, the interest on loan. Well, the provision for bad debt is also highly examined, right? I don't want to add on to what we have just done. If you understand what we have done today, I'm happy. Okay, because it will make your life smooth for the rest of your life in SHS, in financial accounting. So I don't want to add on any further information that would distort it. Now let's deal with the interest on loan so that the last one will be left with will be the provision for bad debt, and that's for the interest on loan. So it's like the business goes for a loan and the bank is charging interest. So normally when you go for loans and there's an interest attached to it, you see in the question something like this. you see maybe 5% loan, then they put the figure there, maybe 150,000. If you see this, what it means is that the loan amount is 150 and the interest on the loan is 5%. Dear professors, don't waste time. If they ask you to calculate or if you see this in your profit and loss account, just calculate the interest, because interest on loan is an expense, right? So under your expenses, you just indicate interest on loan. Then you apply the rate. So in this case, 5% times the loan amount, 150,000. Whatever value you get, you put it there as your interest on loan. In the balance sheet, you also consider this interest on loan, but you consider only the amount of interest they haven't paid. So most of the time, the question will give you a clue that out of this interest, maybe they have paid 5,000 or they have paid 3,000. So your main concern is in the balance sheet, if there is any interest on loan that has not been paid, that is what you put under your current liability. Okay, because interest on loan is an expense, and if you haven't paid for it, it's a liability to you. So for the interest on loan, this is how you treat it. In the profit and loss account, as you see here, the interest charge for the year is debited or added to expense. So you calculate the interest and put it there. If they didn't give you any rate, but you see in the question, maybe interest on loan, 5,000, pick that figure and put it in there as your expense, 5,000. Okay. Then in the balance sheet, any outstanding or unpaid, which the question will tell you that maybe this amount has not been paid, or they would, most of the time they tell you maybe they have paid 3,000. So you would have to work out and see how much has not been paid, and you put it under your current liability. From review of the past questions, this is not highly examinable by WASSCE. It used to be SSE, they loved it, but WASSCE. Okay, so dear professors, I think I'll leave the bad debt and provision for bad debt to another day, hopefully next week. Okay, so like I did with the previous adjustment, I'm going to give you a question that has this time all the 6, or let me say 7, because I've added on interest on all the 7 adjustments we have looked at. Okay, we'll go through together, and then I'll give you similar questions for you to try and submit for me to mark. At this point, I'll pause for any questions. Questions.
Mr. Moore.
Yes, Prof.
Please, could you share the video like after the chat?
Oh yeah, definitely. I would share. I recorded it, so I'll share it in this lesson. Okay, Prof. Sandra, anything from you?
Oh no, please.
Prof. Frank, yourself?
Sam, okay.
Okay, so I'm going to share the video today. I'll try as possible, my possible best to share it within the day so that you can have it. Please, I beg you, take your time and review what I have discussed under this provision for depreciation. For this topic is one that runs through the remaining topics you are going to do. It runs through all of them: single entry and incomplete records, manufacturing account, departmental, final account of a company partner. In fact, they are there. So I beg you, take your time, watch the video, pause where you have to, and don't rush. Okay. For me, I believe in this is one of the topics that when I'm teaching, I would say technically I waste a lot of time because I give my students little information and ask them to process and practice. If not, you give them a lot of information. By the time you realize they don't even remember anything. And that is bad teaching. So I don't do bad teaching. So it might come across like we are not making use of the time. But understand me coming from my expertise and experience that if I rush you through this topic, you would not like it. So let's take our time and do it as we are doing it. I'll be putting more illustrations and assignment on the page for you to try. Okay. I will not necessarily call for you to submit them for me to mark, but if you finish and you submit for me to mark, I'll be glad. Okay. So wrapping up, I think we'll wrap up in the last session. Okay. We'll wrap up in the last session. We have 5 minutes more for this session to end. So let's meet in the last session and then we'll wrap up. But let me use the 5 minutes to drink some water. When I say